You were actually talking about cash. You wanted people to be in cash. Do you still think that's the right call based on how far the market has moved since then?
I mean, it's not surprising it's moved as far as it has. Let's face it, we had the worst December since 1931. Little surprise, we had the best January since 1987. So, stocks have done what they do, which is they overreact in both directions. If we actually break down what's driven it, though, earnings season has been okay. It's kind of been a high watermark in our view, but if you look at forward earnings, they're drifting down to the low single digits. Yes, the Fed are on hold at the moment, but the reality is, have they finished hiking? Look, if we look at Main Street in the US, it's doing just fine. Probably the balance of risk is that the next Fed move will still be to tighten further, albeit some way off.
Do you think that's happening in this calendar year?
I think it's possible that it will happen in this calendar year, because if we look at the underlying data in the US, it's okay. So let's face it, multiples will struggle to expand too far. Low single-digit earnings, multiples where they are. Chances are, could be a reasonable but not spectacular year for stocks. And if you're earning positive real rates on cash, it has a place in a portfolio as something to be opportunistic with.
What percentage of your portfolio, and I know it depends on what your outlook is and how long you're in how long your time horizon is, but right now, how much cash do you want to be sitting on?
Well, I mean, if we look at a modest overweight to cash within a balanced portfolio, you're probably talking a couple of percent above your benchmark, on the basis that we will see a more volatile year this year. We've already seen it in January.
And you want to put that money to work. That's the plan.
Absolutely. This is the point. It's not about avoiding investing. It is about being opportunistic and selective as a more volatile late cycle market.
Do you think we're going to test the lows that we saw in December?
Well, that's a $64,000 question, isn't it? Let's break it apart. If we test the 2350 low and we break through that, we're going to be in a pattern of lower lows. The technical strategists around the street are not going to like that. And certainly we will see some of the nervousness that's been going on amongst investors tested further still. If that low holds, then we could be in something more of a consolidation range. Then we become quite data dependent. And what are we relying on? We're relying on a better European outcome in terms of Brexit. We're relying on a much more positive than already expected resolution to China trade. And we are also, importantly, relying on a recovery in corporate confidence, which remains relatively mooted today.
Santoli, you don't believe we're going back to December?
I don't think the market is behaving as if it is going in there anytime quickly. No. I mean, I think basically you have this textbook pattern which says it's very rare to have a V bottom. They happen, but it's very rare. I think that you would recharacterize it as at some point this should be a scare, or there should be a pullback that gets people thinking we might retest the lows. But that doesn't necessarily mean 2350 in the S&P. The low was 2350 as a close in the S&P. You know how much time we spent under 2500?
How much?
4 days.
That's it?
Right? So in other words, there's really not that much activity. No, tremendous volumes. People did actually get spooked and sell a lot. So my point
it seems
is,
like a lot longer.
The market right now, I think, is still burning up a lot of the skepticism that built up, right? I mean, if you look at the Merrill Lynch Fund Manager survey just out this morning, cash among institutional investors is overweighted more than it has been since 2009. So maybe it's because you're getting a return on cash.
Does that mean that there's a snapback that could come as people start to feel like the water's safer to get into?
I don't know if it's a snapback or it's a continuation. I mean, I think it's a reason we haven't pulled back more than we have.
But it also sounds like a reason that you could see continued gains.
For a while. I mean, I do think that, right now, valuation is somewhere between cheap and expensive, so that's not going to necessarily give you an edge one way or the other. But yes, I do think if you have this sense of, well, maybe we don't have to retest the lows. Maybe, in fact, we've rebuilt a base. It reminds me in some respects of 2016 in the sense of you got a December rate hike that was controversial, then the Fed turned dovish. Then you had bond yields stay very low, and the market just kind of recovered. It didn't get excited. I'm talking about the first half of 2016, even though growth was not that great. So, again, not a perfect analogy, but I think you burnt up a lot of that skepticism.
John,
I'm sorry. Go ahead.
Yeah,
Why is it not right?
I think that anchoring this back to 2016 means that what you're essentially doing is you're winding the clock back to an economy that still had slack in the system, where we hadn't seen the big dose of stimulus that came through in the US that was surrounding tax cuts and the fiscal stimulus that we got. We're going to be on the backside of that. Global growth was just picking up. We had massive China stimulus going through at the time.
That's right.
So far, the China stimulus we've had has not even unwound some of the tightening. More importantly, given the nervousness around trade, we've seen a significant build in inventories, both at a national and at a corporate level. Even if we allow for some continuation of good news, we still have to work through those inventory routes. So the risk is that economic data have to reflect that softness for a period of time. This is not a period where we've got negative real rates, which we had in 2016, where you get that go-go reaction from markets.
Not here. Yeah.
I think this 2019 will characterize a late cycle environment where the Fed have paused not in order to stimulate and push forward asset prices, but partly because economic data have moderated.
We got to run, but what do you think's in the market for this China trade talk? Meaning, what do you think the market already has baked into the cake?
Well, I think if anything, it's getting a little bit excited, perhaps a touch ahead of itself. Do we want to see a deal? Absolutely. Will it unwind the tariffs that have been put in place or address some of the key questions around intellectual property rights, cybersecurity, etc.? Maybe not. This could rumble on for a while, even if we get a temporary hiatus and some agreement coming through.